How can I understand confusing startup financial statements? Imagine trying to read a map in a foreign country. It looks complicated at first, but once you understand the symbols and routes, it becomes easier to navigate. Startup financial statements are similar. They might seem confusing at first, but with a few simple steps, you can make sense of them. Start by focusing on the three main types of statements. The first is the balance sheet. Think of it as a snapshot of what the startup owns and owes at a specific moment. It shows assets like cash, equipment, or property. It also lists liabilities, which are debts or obligations. The difference between assets and liabilities is called equity, which is the owner's stake in the business. Remember, the basic formula is assets equal liabilities plus equity. Next is the income statement, also called the profit and loss statement. This shows how much money the startup earned and spent over a certain period. It includes revenue from sales or services, costs directly tied to making products, and operating expenses like salaries, rent, and utilities. After subtracting expenses from revenue, you see if the business made a profit or a loss. This helps you understand if the startup is financially healthy. The third is the cash flow statement. Think of it as a real-time tracker of cash moving in and out. It is divided into three parts: operating activities, which cover cash from the core business, investing activities, which involve buying or selling assets, and financing activities like loans, investments, or dividends paid. This statement shows if the startup has enough cash to keep running day to day. To really understand these statements, start with the cash flow statement because it shows the actual cash coming in and going out. Then, look at the income statement to see if the startup is making money. Finally, review the balance sheet to understand the overall financial position. Compare these statements over different periods, like month to month or quarter to quarter, to spot trends. For example, rising expenses or declining cash flow can signal issues. Use simple tools or templates designed for startups to organize the data clearly. If something isn't clear, don't hesitate to ask an accountant or financial advisor. They can explain specific line items or help interpret the numbers. Knowing these basics helps you see how a startup manages its cash and finances. This understanding can be useful if you are thinking about investing or working with startups that provide insurance or financial services. It also helps you make smarter decisions about your own family's money and financial planning. By breaking down these statements into manageable parts and focusing on what each one tells you, you can get a clear picture of a startup's financial health. This knowledge is powerful and can help you make better choices about funding, insurance, or managing your family's money wisely.